Meantime, big week for the retailers. Home Depot, Target, TJ Maxx, and Ross stores are some of the companies reporting. Joining us right now is one of the analysts who covers the sector, Eric Clark, Accuvest Global Advisors portfolio manager and CIO. What are you expecting? And maybe more importantly, if you're an investor, what should you do ahead of these numbers?
Well, I mean, retail has definitely been bifurcated. The home builders, they're cheap. They have terrifically low comps, but we don't really seem to have a catalyst with rates going up. So we don't really expect too much out of Home Depot and Lowe's. They had about 8 consecutive quarters of negative comp sales. They had positives last quarter. It'll be interesting to see where we go for this quarter this week, but we're just lacking the catalyst on the home side.
Is there a retailer right now you think that has a catalyst?
Well, I think TJ Maxx continues to be a great place to be. That they're focused on giving people great value, giving them branded apparel as well as home goods. So the home goods side has a little bit more tariff exposure, but TJ Maxx has been a good performer. It's up 11% year to date, I think, and that's delivering the value that people need when they're being squeezed from inflation.
What do you make, by the way, of the comments by Scott Bessent over the weekend and the president as it related to Walmart? And do you think, could you see that coming to other companies as well?
Well, I guess perhaps, but these are for-profit enterprises, so they thrive on high volume and low margins. So when their margins are getting squeezed, they have to do something. Obviously, operational efficiencies are part of that, but I think it's a little wrong-footed to be bashing the retailer when they're doing whatever they can to keep prices low.
How do you feel about either transparency or indicating to the customer why something's moving, especially if it's big, if it's a big material item?
Well, I love the transparency. Consumers love the transparency. The administration clearly doesn't love transparency because that runs counter to the narrative. But in the end, these consumers are doing whatever they can to keep traffic high, to keep delighting customers, and they'll use operating efficiencies where they can, but at some point you have to raise prices just a little bit to offset that to keep your margins stable.
Do you imagine there's going to be more M&A activity in retail land? I'm thinking just last week, obviously, the Dick's Sporting Goods deal with Foot Locker, and whether you think that portends more action in the same space?
Well, I'm actually surprised by the Dick's because they were doing pretty well. I'm not sure that's going to be a great acquisition for them. We'll see. But, if you are a second or third tier retailer, then yes, you're thinking about M&A to try to figure out how to survive. But, the biggest retailers are the best positioned to deal with these kinds of problems. They've been through it for multiple decades, different scenarios. So that's why we're certainly staying up in quality and up in market cap with the 1 or 2 market share companies, because not every company thrives when inflation and interest rates are where they are.